record. So I just record the. Okay, so make sure that you keep up with the good work, okay, and you will do well. Okay, you will do well. So chapter 6 is about cost, volume, profit. Cost, volume, profit. Okay, so we have 6 learning objectives. So the first one, we want to learn how to prepare the income statement, the cost, volume, profit. Okay, cost, volume, profit, income statement. Okay, so we can learn how to determine the contribution margin. Okay, and the second learning objective is the break-even analysis. Okay, break-even analysis. So this is a very useful tool. Okay, I'm going to show you how to find the break-even point using 3 methods. Okay, and learning objective 3, we want to determine the sales required to earn the target operating income. Okay, so suppose you want to have a target of operating income, right? You want to make $1 million before tax, right? And then you want to learn, okay, so how much sales, right? I have to make in order to make them money, right? And then we are going to introduce this new concept of the margin of safety. What is called a margin of safety? Okay. And number 4, we're going to learn how to use this tool. Okay, we're going to learn how to use this tool. And number 5, we're going to take a look at sales mix, right? So sometimes when you sell a product, that product is a package, right? So you are not only selling an internet service, right? You also have a home phone line, right? You also have cable, right? It could be a sales mix, right? How does that affect all this analysis? And number 6, that's the cost structure and operating leverage. Okay, I see some hands up. Just give me 1 second. So somebody had hands up a minute ago. Do you have a question? No? Okay. Oh, Rachel, you have a question?
I do. Just a quick question about our project. Sorry to ask, like, just at the beginning. I just wanted to know if there will be more information released about our project soon.
Okay, so the project that project is about budgeting, right? So that project will not be released until we are learning the chapter for the budget. Okay, so once we learn that chapter, once we are in that chapter, I'm going to assign that work to you guys. So we just haven't, we are not there yet. Okay, so it's not very useful to assign the work now. Okay, so once we are teaching that chapter, I will assign that work.
Okay, thank you.
Yeah, no problem. Okay, so why do we need this CVP, cost, volume, profit analysis, right? So just literally, you see the cost, right? You understand cost. Volume is mostly the level of the activities, right? That's the volume, and the profit, right? That's what's essentially the company cares about, right? So cost, volume, profit analysis. Okay, so basically we are trying to understand when there's a change in the volume, the level of the activities, and there's a change in the cost, how does that going to impact on the profit, right? Because as a manager, as a decision maker, we want to make sure we understand how these things changes, right? Will affect my profit. Okay. So this is a very important, tool for the decision making. Okay, profit planning. So basically, this analysis consider 5 components, right? 5 components. So the first one is the volume, or we call it the level of activity, or the quantity. Okay, the volume. Okay, so how many furnitures you are going to manufacture, right? That would be the volume. And unit selling price, how much you can sell this furniture for, right? Sometimes if the market is very competitive, right, the selling price is not determined by you, it's determined by the market, right? So the unit selling price and the unit variable cost, okay? So how much it costs you, right? The variable cost to produce, to manufacture each unit, okay? And the total fixed cost. What is the amount of the total fixed cost for the company, okay? And sales mix, okay? Sales mix. If you are selling, you know, in package, right? There's a sales of mix of different products, right? So that can also impact this analysis. So that's the 5 components that will be critical to this analysis. And we're going to need these informations when we are doing the analysis. What are the assumptions, right? What are the assumptions? So, so when we perform this analysis, there are some underlying assumptions, okay? So this analysis is not, you know, 100% correct, right? But it's just a simplified model for us to quickly grabbing some numbers to perform analysis to, you know, to get some insights, right? So it's not 100% correct. It's a simplified model, okay? And in order to make this work very well, there are some underlying assumptions. The first one, oops. Okay, so what happened here? Okay, so the first one is that the volume, right? The volume index and the profit, the revenue and the cost, that is a linear relationship. Okay, it's a linear relationship. So we are saying the activity volume, okay, the volume and the revenue, that's a linear relationship, okay? And so basically, let's say per unit, right? Per unit is $12, right? So 1 unit, the selling price, the revenue is $12, right? So that will be a linear relationship, right? But you know, sometimes, you know, when you sell in bulk, right, you give them discount, right? So that's the thing. We are assuming that in the relevant range, if you still remember the concept of the relevant range, right? In that range, the selling price is fixed, right? I say $12 per unit. So that will be a linear relationship, right? The cost per unit, right? The cost per unit is also a linear relation, okay? So this is one important underlying assumption. Second, we assume all the costs will be can be classified into either variable cost or fixed cost, okay? So we are assuming that for every cost, okay, we either can classify that as a variable cost or a fixed cost. Number 3, we are assuming that the inventory level doesn't change. So essentially that means the production equals the sales, right? The units of production equals the units of sold, okay? Whatever you produced in the period, that is all being sold, right? So your inventory level doesn't change, okay? And so when there's more than one product is sold in the package, we assume that that sales mix doesn't change, right? So suppose that sales mix contains maybe 2 cups and 2 cups and 1 pencil, right? Okay, so we assume that this is always the same, right? You do not sell, you know, 10 pencils, 1 cup, right? That sales mix is always 2 cups, 1 pencil, okay? So that's the assumption. And the last one is the costs are only affected by the changes in the activity. Okay, no other things will affect the cost, right? So for example, electricity cost, right? Utility cost. right? We would think this would be, there is a fixed component, there is a variable component, right? So we are saying, well, it's only the more we are producing, the variable component is more, right? But what about the unit rate? What about the electric plant is charging higher rate, right, per unit, right? So the whole point we are saying is that we assume that the only factor affecting the variable cost of the utility is the level of the activity, right? It's not other factors. Okay, we are not considering other factors. Okay, with all these assumptions, we could perform the CVP analysis. Are we clear? Does anyone have any question? Okay, so this is the format for the cost, volume, profit, income statement. Okay. Note, this is not the financial statement you are learning from 2100, right? Those are for the external users, right? So this, we are in the 2400. The information we are talking about is all for internal use, right? And basically, this concept of the contribution margin, right? The concept of contribution margin is just the revenue minus all the variable cost, okay? That including product cost and the period cost. Okay, so what's the contribution margin? Contribution margin is the difference between revenue and all the variable costs. Okay, and that including both product variable cost and also period variable cost. Okay, so you have sales and you minus variable cost. Okay, so what is the variable cost? This total variable cost has two components: product variable cost add period of variable cost. Okay, so this two number, the difference, that's your contribution margin. Okay, hopefully you want to have enough contribution margin to cover the fixed cost, right? The fixed cost has also two components: product fixed cost and also period fixed cost. Okay, so if you have enough contribution margin to cover this fixed cost, you are going to have an operating income, right? You're going to have a profit. Okay. Are we okay with this format? This is the cost, volume, profit, income statement format. Are we okay with this format? Anybody have any question? Ruben, you are muted. You have a question?
Oh, I was just saying I'm okay with the format.
Okay, good. Okay, so so note that, so basically sales minus all the variable cost, right? So you categorize all the cost into either variable cost or fixed cost. So sales minus all the variable cost, that's your contribution margin. And contribution minus the fixed cost, that's your operating income. Okay. And you remember our assumption, all the costs will be either classified as a variable cost or as a fixed cost, right? Okay, so that's the format. Sales minus total variable cost, that's your contribution margin. And contribution margin minus fixed cost, that's your operating income. Okay. Yeah, so the contribution margin has to cover the fixed cost. Yes, right? You want that to be the case, right? Otherwise, you are losing money, right? It can happen, right? If you start a business in the first year, the company often maybe in a loss position, right? That's normal, right? But over the long time, right, you would hope that eventually your contribution margin should be sufficient to cover at least fixed cost in order to profit. So here's one example. Suppose the selling price of the unit is $300. So we sell this unit $300. Here are the variable costs, okay, for each unit. So for each unit, the variable direct material, direct labor, the variable cost is 150, and here for the labor is 50, and sales commission. So basically, we pay the salesperson $10 if they are able to sell a unit, okay? That's the variable period cost, right? This is not the product cost, but it's a variable cost, right? The more the salesperson can sell, the more the salesperson will receive, right? Admin expenses, right? So that's a 15. So when I add up all these numbers, I got the total unit variable cost is 175, okay? So what's my contribution margin per unit? Anybody? James?
125.
125, right? So you use your unit selling price minus your unit variable cost. So that's your contribution per unit, right? So 300 minus 175, your contribution margin per unit is 125, okay? Suppose we sold 2,000 units, right? So my total contribution margin from the 2,000 unit would be contribution margin per unit times 2,000. So 125 times 2,000, right? So my total contribution margin is 250,000, okay? And we also learn some fixed cost information. I have some fixed manufacturing overhead, fixed sales personnel salaries, fixed CEO cost, fixed accountant salary cost. So this is all fixed cost, right? And the total is 125,000. Okay, so let's translate into the CVP income statement format. That would be something like this. Okay. You see, you start with sales. Okay, so $300 per unit times 2,000 units. So that's the 600,000. And then you work on this variable cost component. And we figured out the total variable cost is 350. And my total contribution margin is 250, right? We have already calculated this. And the total fixed cost is 125. So difference, we have enough. The difference, 250 minus 125, that's my operating income, 125,000. Okay, so that's a good condition. I have enough contribution margin to cover my fixed cost. Okay, are we okay with this? Anyone have any question?
No, we're okay.
Okay, good. Okay, so what is the break-even calculation, right? So the break-even calculation means the operating income is zero, okay? You didn't make money and you didn't lose money, right? So that's a special situation. You didn't make money, you also didn't lose money either. So your operating income is zero, right? So when your operating income is zero, okay, that means your contribution margin is simply just exactly the same as the total fixed cost, right? So only under that situation, your operating income is zero, okay? So if you want to cover the total fixed cost, 125,000, okay, and the contribution margin unit is 125 per unit, so you have to sell 1,000 units, right? So you have to at least sell 1,000 units to break even. Otherwise, you are losing money, okay? If you don't sell anything, okay? If you don't sell anything, how much money do you lose? If this company doesn't sell anything, okay? 0 unit. Thomas, how much money do you lose?
125,000 or
125,000.
That's the fixed cost, right?
Yeah.
So in order to cover that cost, you have to sell at least 1,000 units, right? Because each unit give you a contribution margin of 125. If you sell 1,000 units, the total contribution margin is 125,000. So that's just exactly the same as the fixed cost, right? So under that situation, your profit is 0, right? Okay, so how did you do the calculation? You use the total cost, 125,000, divided by the contribution margin per unit. Okay, that's the 1,000. So take a look at the statement. So now I have 1,000 instead of 2,000. You can see the sales is 300,000. My contribution margin is 125,000, which is equal to the fixed cost, total fixed cost. So my operating income is 0. So we are saying that this is a critical situation, right? I have to sell at least 1,000 units in order to break even, right? I didn't make money, I didn't lose money either, right? So if yeah, go ahead. Isabella, go ahead.
Hi, sorry, I think I got lost. So I know where you got the $125,000 from, because that's your fixed cost, but where did you get $125?
That's the contribution margin per unit. That's this one.
Oh, okay, perfect. Thank you.
Contribution margin per unit. Yeah.
Okay, thank you.
Yeah. No problem. Anybody else? Does this make sense? Break even, right? This is, as a company, this is probably a very good estimate, right? If I perform this analysis, give me some idea, right? How much sales I need to have, right? So this tells me, right, to break even, to cover my fixed cost, I have to at least sell 1,000 units, right? Okay, so let's move on. First question. A company can achieve an increase in contribution margin given no other changes if okay, Michaela?
If their variable cost decreases.
Variable cost decreases. Kit Chen?
D.
Variable cost decrease.
Yes.
Reg?
Variable cost decreases.
Ruben?
D.
Stephen? Xudong? Are you there, Xudong?
Yeah, can you hear me?
Yeah, what's your answer?
D, variable cost.
Okay, good. Yeah, very good. So the answer is D, right? The answer is D. So basically, we are saying that so if your variable cost decrease, right, your sales minus the variable cost, that's your contribution margin, right? So variable cost decrease, contribution margin will be higher. Very good. Okay, so now let's talk about this contribution margin ratio. Okay, contribution margin ratio. We also call it in short CM ratio. What is the CM ratio? CM ratio is just the contribution margin per unit divided by unit selling price. It's a ratio, right? It's a ratio, it will be a percentage, right? So contribution margin per unit divided by unit selling price. That's your contribution margin ratio. So in this example, my contribution margin per unit is 125 and the selling price is $300. So this ratio would be, if you do the calculation, 41.67%. This is my contribution margin ratio. Can anyone tell me what is this ratio, the range of this ratio? Okay, so let's see. Ruben?
Sorry, I forgot to lower my hand.
Okay, so what's the range of this ratio? Can this ratio be more than 100%? Lemmy, can this ratio to be more than 100%?
No,
No.
Why?
because to achieve the contribution margin, we have to first take out the variable cost from the selling price, and it's what we have left that we then take over the selling price.
Yeah, the contribution margin can never be more than the selling price, right? So it's always less than the selling price because there's the variable cost component. Therefore, this ratio is always less than 100%. Okay. And you're going to see that why this contribution margin ratio is useful. Okay, why it's useful. Okay, so what does this mean conceptually? Conceptually, for every $1 of sales you received, how many of that $1 is used to cover the fixed cost and earn profit? Okay, that's what it means. What this contribution margin ratio means? In this case, for every $1 you received, 42 cents will be used to cover the fixed cost and to make profit. Okay. Okay, so if the company, if ABC manufacturers sales increase by 100,000, if the sales increase by 100,000, the total contribution margin will increase by contribution margin ratio times the increase, which is 41,667. And therefore, the operating income will increase by 41,667. Does this make sense? Does this make sense?
Yes, Professor.
Yes,
Thank you.
it does.
Yeah. So when the sales increase by 1,000, okay, and the contribution margin will increase, right? And it will increase by how much? The contribution margin ratio times the increase in sales, okay? And the operating income will increase by 41,667, okay? So if you don't believe me, so I believe I have an Excel sheet. Okay, so I'm gonna show you this. Just give me 1 second. I'm opening the Excel sheet here. Okay, can you see it?
No.
No?
No.
Okay.
No.
Okay, so I'm going to show you here. Going to share the screen. I'm just going to share this one, okay? Okay, this is not a good view here. Into zoom to 200, okay? Okay, can you see better now?
Yeah. Yes.
Yes,
Okay.
much better.
Awesome. So remember, one is 2,000 units, right? Okay, so if I sell 2,000 units, for the same example, this is the format, right? So I have sales 600,000, and my total contribution margin is 250,000, right? And operating income is 125,000. So this one we have just seen, right? When I sell 2,000 units, I will show you. So we are talking about this one, right? We are talking about when I sell 2,000 units, the number is 600,000. Contribution margin is 250,000, and operating income is 125,000. Okay, so that's what I'm talking about. But I'm making this this format in the Excel sheet: 600, 250, and 125,000. Okay. So now, in order to increase the sales by 100,000, right? So I need to make this number to be 700,000, right? 700,000. Okay, so how many units I need to make? So I need to make 700,000 divided by 300. So I need to make 2,033 units. So now see, my sales is 700,000 now, right? And my contribution margin is 291,6667. So if you compare this, it used to be 250, right? And now it's 291. The difference is 41,667. And the profit, right? The operating income used to be 125, and now it's 166,667. So the difference between this number is 41,667. Okay. Are you convinced by this or whatever I'm doing?
Yep.
Yeah. Okay.
Yeah.
Good. So you need to learn how to use Excel. You build a template, okay, and then when you change the number, all the other boxes will be changed correspondingly, right? So make sure you learn how to use Excel. Okay, so you see how useful this contribution margin ratio is, right? When you talk about change, right, you can use this contribution margin ratio.
Professor, can I
Yeah.
ask a question?
Yeah, go ahead.
I don't know if this is a premature question, so maybe I should hold it till later because much into the text when it was there was a comparison between a company that became automated and a company that had a huge that had a higher direct labor cost, which is a variable cost. There was a question of profitability there, and I got confused because it looks like the company that had a higher variable cost was more profitable than the company that had a higher fixed cost. So I was a little bit confused there. I don't know if it's something you can explain, or maybe you want to wait till later. I don't know.
Maybe when we discuss that topic, it will be nice to talk about that example when we touch that topic. So far we haven't talked about those things yet.
Okay. Thank you very much.
Yeah, no problem. Yeah. Okay, so for this question, you guys are fast, huh? I haven't even read the question. Okay, so let's take a look. Contribution margin is Tammy.
Sorry, Didi. Okay, I didn't. Is it me?
Yeah.
Oh, okay. Sorry. It's sales. Sorry, it's sales revenue less variable cost.
Okay. Yeah. Loan.
I got C.
Fixed cost less variable
Oh
cost.
no. I got A, yeah.
Okay. Megan.
I also got A, sales revenue less variable expenses.
Okay, good. So the answer is A, right? The answer is A. Okay. Okay, let's keep going. Break-even analysis. Okay, so this is the process of finding the break-even point. So why we perform the break-even analysis? Because we want to find what's the point, break-even point. Okay. So what is the break-even point? This is the level of the activity at which the total revenues equals the total cost. So operating income equals 0. Okay. That's the break-even point. How can you do that? There are three methods. Okay. Either you can use a mathematical equation. You can use a contribution margin. Okay. So this will be using calculations. And the last one is you are using a graph. You can, draw this graph, and so from the graph you can figure out what's the break-even point. Okay, so that's the three approaches you can use. So break-even point, okay, can be expressed either in units or in sales dollars. Okay, I have created a video for you guys. Okay. If you have watched that video, in that video I explained, right, the break-even point in unit and the break-even point in dollars of sales, right? Okay, but it's the two numbers are very it's easy to convert between the two numbers, right? So when you say units, you are saying how many items I need to sell, right? How many units I need to sell, right? And then you're talking about how many sales dollars I need to generate. That's easy, right? Just use the number of the units times the selling price per unit, okay? So nothing too complicated between that two expression, right? They are, the only factor is the selling price per unit, okay, between the two expressions. Okay, so the first one, let's take a look at the mathematical equation, okay? So this is the equation, okay? Selling price, that's S, okay? Q, that's the volume, okay? That's the volume. So S is the selling price per unit times volume. This gives you the total sales, okay? Your total revenue, okay? And V is the variable cost. And when V multiplied by Q, this gives you the total variable cost, okay? And TFC, not KFC, right? Not KFC. You may be hungry right now. This is the TFC, total fixed cost, okay? So variable cost, total variable cost, plus total fixed cost. That's your total cost, okay? So on the left side of the equation, that's your total revenue. On the right side of the equation, that's your total cost. It has two components, the variable and the fixed, okay? So that's this equation about, this mathematics equation about, okay? So in my example, the selling price is 300. So 300 times Q, right? That's, the Q is what I'm looking for, right? Equals the variable cost per unit, 175 times Q, right? And plus my total fixed cost is 125,000. Okay, so this is the equation. Okay, and this is high school stuff, right? So I think you should all know how to solve this. At least I hope so. Okay, so you move this 175Q to the other side of the equation. So you get 125Q equals 125,000. So when you solve it, you divided 125 on both sides. So your Q equals 1,000 units. Is that clear? This is high school stuff, right? Okay, so that's break-even point in units, right? Units of sales, 1,000 units. Any question? Okay.
Yes, Professor.
Yeah, go ahead.
Unless I just want to confirm. So unless you specify which of the method you want us to use in say an exam situation, if it's just to find the units, we can use any of this method. Is that correct?
Yeah, they are actually the same. Actually, they're just in different forms, right? So to me, whatever you figured out, what's the break-even point? That's good, right?
Okay,
so underlying, this is all the same. So no big difference.
Okay. So,
yeah, I'm surprised the textbook even make this to be a 3. I would say it's 2, right? But they make this 3. But anyways, yeah. And then the contribution margin technique. So we can use that contribution margin CM technique. So how you do that? So you use your total fixed cost divided by the contribution margin per unit. That's your break-even units. Okay. So in the example, oops. Okay. In the example, your total fixed cost is 125,000. Your contribution margin per unit is 25. So you use your total fixed cost divided by contribution margin per unit. Okay, that's your break-even point in units, 1,000 units. In dollars, right? In dollars, you know that, right? Each unit sells for 300. So 1,000 times 300, you should get $300,000, right? That's the break-even point in sales dollars, right? But you can calculate this in a different way. You use the total fixed cost divided by the, do you remember what is this percentage? Do you remember the term? 41.664%. Do you remember this?
Yes, it's the
Megan?
CM ratio, the
Yeah, CM
contribution
ratio.
margin ratio. Yeah.
Yes, exactly, CM ratio, right? So you use your total fixed cost divided by CM ratio, you get the break-even point in sales dollars, okay? You use total fixed cost divided by the contribution margin per unit, you get break-even point in units, right? Is this simple enough? Just do a division. My kids is in a grade 5. they are learning all this kind of stuff, okay? So that's my second method, contribution margin technique. This is probably easier method, right? Instead of laying down that mathematical equation, right? This one is just do division of two numbers, right? So I think this is a much easier method. But the fun method is really about the graphic, okay? You can draw the picture. So in this picture, this cost volume profit shows the cost, volume, and profit. And you can visually, right, to see what is that break-even point, okay? In order to draw this graph, okay, you need to remember the linear relationship, right? You need to draw a line for the revenue, okay? And you need to draw the line, the linear, right? You need to draw the line for the cost, the total cost, okay? And what is the break-even point? Okay, I'm going to show you very quick, okay? So here is one example, okay? Are you able to see the graph, okay?
Yeah.
This blue line, okay, this blue line, okay, that's y equals 300x. Can anyone tell me what is this line, the blue line? It's y equals 300 times x.
That's your sale line?
Pardon me?
Is that your sales line? Or
Yeah,
your...
that's my sales, right? Because my selling price is $300 per unit, right? And x is my volume. So so this y is my revenue, right? Y is my revenue in dollar. So this blue line is actually my sales, right? Representing my revenue. Okay. And then you take a look at this orange line. So y equals 175x plus 125,000.
Total cost line.
Total cost line, yeah.
Yeah, total cost line, right? And you can see 125,000. This is the fixed cost, right? And this 175, right? That's my variable cost per unit. So this is my variable cost. So together, this is my total cost. So what is the break-even point? Break-even point is when my total revenue, sales revenue, equals the total cost, right? So when are they equal, right? We are talking about the cost equal, right? Revenue equals the cost. At what point they are equal? How do you know? You can see this strong arrow pointing to this point. This is my break-even point, okay? And this at this point, these two lines across each other, okay? And this is about geometry, right? So you think about the two parallel lines, they will never cross each other, right? Two parallel, right? Like the railway rails, right? They will never cross to each other. But for other lines, okay, straight lines, how many times they can cross each other? One time, right? Only one time, right? Only one time. So here, this blue line and this orange line, they crossed at volume 1,000, right? at volume 1,000. So we know this 1,000 units, that's the break-even point in units, okay? And this 300,000, that's my break-even point in sales dollars, right? In sales dollars.
Professor, may I ask a question?
Yeah.
Is it okay to say that the break-even point is a point where the CM is equals to the FC? The contribution margin is equals to the fixed cost. Will that be another way to look at it? Thank you.
Yes, exactly. Yeah. Okay, so then what happened when sales, the blue line is above the orange line? So when the sales line is above the cost line, that means you are making money, right? So if you take a look at this green zone, right? I shaded with the color. Oops. This green zone, okay? So that's my profit, right? Because my sales revenue is higher, right? My sales revenue is higher than the cost. So I'm making money. So this is this zone. So as soon as you pass the break-even point, right? And you start producing more, the more you produce, you are making more money, right? You can see the vertical distance between the two lines, right? And if you didn't made it to this break-even point, that's take a look at this this reddish shade area. This would be your operating loss. Okay. Does this make sense? Does this picture make sense?
Yes, Professor.
Yes, please, and thank you.
So what is my volume? Can anyone tell me what's my volume? So remember, this is CVP, right? Cost, volume, profit. What's my volume in this picture?
1,000 units.
Yeah, so that's my break-even points, right? So the volume is my x-axis, right? This is the volume of the production, right? This is my x-axis, right? This is my volume. What's my cost? So my total cost is represented with the vertical axis, right? The vertical axis. And what about my profit? What's my profit? The profit is this shaded area, right? Right? So this is the CVP, right? CVP graph, right? Cost, volume, and profit. Okay. So I make this graphic using Excel, okay? I can show you how I make it. Okay, so this is a basic picture I used, and I make it prettier, right? Because this is not acceptable. This is not pretty enough. So basically, you can see that I have 1, 2, 3, 4. I have 3 columns, right? One column, this is the volume, okay? And this is the total revenue, and this is the total cost. And then I can just use this 3 column. I can just do this graph. See, right? I got this graph, and then I can add all this. If you remember, right, how we do this, we can add a trend line, right? And then we can display the equation, right? If you remember all those. Okay, so if you want to do your own CVP graph, you can use it. You can use Excel to do it. Okay. Okay, is this clear? Are we good with this?
Sorry, Professor.
Yes.
Could I ask about how you did that? Is it the same way that you did the when we were creating the regression line?
Yeah. So you click these dots, right? They all selected.
Okay.
And then you add a trend line, and you pick a linear, and then you display equation, right?
How about the data?
The data?
Yeah, it looks like the data is a lot more than.
I just make them to be 200 increments, okay? 0, 200, 400. So what you can do is actually, so if you delete this, so you put a 0 here, and then if you want the increment to be 200, and you highlight this two, and you drag and they give you this row of the sequence that is the 200 increment. Okay.
Okay.
And then the sales just use volume times 300. Okay.
Mhm.
And the total cost you use 175 times volume plus the fixed cost. Yeah,
Mhm.
that's how you generate all these 3 columns.
Okay.
Yeah.
Thank you, sir.
No problem. Okay, so that's my picture. So are we okay with this? So what's the problem with this method? Does anyone can tell me what's the method with this problem? What's the advantage and what's the problem? Megan, what's the advantage? What's the limitation?
I would say the advantage is it's visual and you can visually see where it's happening, but it's not exactly accurate. Like, unless your dollar and your unit amounts are exactly equal like that, you won't be able to really tell what your break even is.
Yeah, that's a very good point, right? So in this question, I purposely make it to be visible. You can see the dot that just happened to this clearly, right? But in other case, maybe it's not that obvious, right? So if you have to estimate, maybe it's not accurate. I agree, right? You know, when you see this picture, it's pretty clear, right? Where that dot is, right? But to know what is the exact amount of the dot, then that's challenging, right? In the graph. So the advantage, this is the visual depiction, okay? You can easily spot the areas for the profit and loss, okay? The challenge is sometimes it's just hard to read what is the number, right? What's the value for those break-even point? Okay. Question, which of following represent how the break-even point in units calculated? Okay, let's take a look. Okay, I already asked it. Lemmy already participated. Mario?
Yeah, is it next, well, C, fixed cost divided by contribution margin?
Okay, and Karen?
I would say C also.
Jimmy?
C.
Okay. Nima?
I was gonna say C.
Dan?
Yeah, I'm gonna agree with C.
Maddie?
I was gonna say C as well.
Okay, C is right. I dare not to disagree with you guys, okay? Because you guys are always right. Okay. So now, what about we have a target operating income? Okay. So far, what we have done is, suppose we are doing this analysis, we're saying under what condition we are not making money at all, right? What if we have a target, right? We have a target operating income. Then we want to work backward to see how many sales I need to make, right? How many sales I need to make. So that formula can be easily adjusted, right? That formula can be easily adjusted. So I want you to focus on these equations. So you have to agree with me, your total contribution margin minus total fixed cost. That's your target operating income, right? That's your target operating income. So then you have to generate total contribution margin equals, okay, the two components together. First, you want to cover your total fixed cost. And then there's enough left to meet your target operating income. Okay? So that's your total contribution margin, right? And your total contribution margin is calculated by sales times contribution margin ratio. Okay, so you can see total contribution margin, okay, equals either this or this. Okay, now let's connect the two. Sales times contribution margin ratio equals total fixed cost plus target operating income. So what's the target sales need to be? Target sales equals total fixed cost plus target operating income divided by contribution margin ratio. Does this make sense? It's just some kind of algebra, I guess. Does this make sense?
I feel like it's more confusing than the one the textbook used.
Okay, so don't be confused. I'm really strong with math, so I'm not making any mistakes here. Okay. I have that confidence.
I have a question about the textbook, actually.
Okay.
On page 613.
Page 613.
Yeah, the second bullet point under target operating income after tax, it says management can calculate the operating income after taxes by subtracting the tax amount from operating income before taxes.
Mm-hmm.
And I don't know that that's right. Or I can't figure out how that is right.
Yeah, I can show you. Yeah, I can show you. Cool. Yeah, so let's go this step by step, right? So now we are talking about operating income before tax, and we are going to talk about net income later, okay? So I will come back to this question you just asked, Megan, okay? So here, okay, here, the generic formula is TFC, total fixed cost, plus operating income divided by CPU, okay? The contribution, CMU, I was wrong, contribution margin unit, okay? That's the unit of sales required. So this is the generic kind of formula. So let's take a look. When you do break even, right? When you do break even, okay? So in this example, the selling price is 80, variable cost is 60, the total fixed cost is 12,000. So I can quickly, based on these two information, I can quickly calculate contribution margin per unit is the selling price 80 minus variable cost 60. So contribution margin per unit is 20. The contribution margin ratio is 20 divided by selling price. So that will be 25%, okay? So $20 per unit. That's my contribution margin per unit. And contribution margin ratio is 25%, okay? So what's the break-even point, okay? So scenario one, I want to figure out what's my break-even, okay? So when you break even, operating income is 0. So you have fixed cost, 12,000, plus operating income, that's 0, divided by 20. So that's 600 units. What's your dollar sales required? Again, 12,000 plus 0 divided by contribution margin ratio, 25%. So that's 48,000, okay? Now, right, what if I want to make an operating income of 10,000? Okay, you use the same formula. So you use 12,000 plus the target operating income, 10,000, divided by contribution margin per unit. So that's 1,100. Mm-hmm. So in order to make an operating income of $10,000, you had to sell 1,100 units. If you only sell 600 units, you are not making money, okay? You are not losing money either. But in order to make 10,000 income, you have to sell additional 500. Why? So right, 600, 1,100, so that's additional 500, right?
Correct.
Why additional 500 will help you to make $10,000?
Because you just multiply that by the selling price. If you multiply the difference by the sales price, you should get that.
So 500 times sales price, 80. So 80 times 500, that's 40,000.
Uh-oh.
You are getting close. You are getting close. Yeah. So why can anyone explain to me why additional 500 will help you to make $10,000 operating income?
Well, I feel like she was on the right track with the extra.
Yeah, she's on the right track. Yeah.
Yeah, it's the extra 40,000. So with 600, we see that's 48,000 plus 500 more units will give you that 88,000.
Okay. So additional 500, you make operating income of 10,000. What's 10,000 divided by 500?
It's the
It's
contribution
contribution per unit. You will
Okay,
get.
it's the $20, right? So basically, each unit will help you make additional $20. So if you make additional 500,000, have 500 units, you are going to make additional $10,000, right? Correct? 600 units make you break even. Additional 500 is going to make you to earn $10,000. So remember this formula, right? So whenever you have a target of operating income, just use this formula, right? Just use this formula to figure out what's the expected sales in units or in dollars, right? Does this make sense?
Yes.
Anybody have any question? The $40,000 is here, right? So the sales is from 48,000 increased to 88,000, right? That difference is the 40,000. Yeah. Okay, so okay, so now I want to show you, okay, graphically, right? I want to show you graphically. So first, you know this is the break-even point, right? This y equals 80x, the blue line, and y equals 60 plus 12,000, that's orange line. When they cross the 600, that's the break-even point in units, and that 48,000, that is the break-even point in sales dollars, right? Now I want to make some profit. How much I want to make? 10,000, right? So in this picture, you know, this red arrow represents 10,000 from 60,000 to 70,000, right? My units here is by each unit is 10,000. So I'm just measuring the vertical distance from 6 to 7. This red arrow represents $10,000, right? So I'm going to move this red arrow to my profit area. Remember, this area is my profit area, right? So if I can fit this measurement, that means if I can just fit exactly, okay, this red arrow between the two lines, that's where I want to be, right? That's the $10,000 operating income. So I moved this here. I realized this is a good point, okay? And then I can see it's between 1,000 and 1,200. So that's the 1,100. Okay, that's the 1,100. And here is the 88,000. Okay, 88,000. Does this make sense? Okay, because this gives me, because here, okay, the blue, the difference between the blue line and the orange line, that's the 10,000, right? That's what I want. And I find this is here would be less than 10,000. here would be more than 10,000. Okay, so that there's only one gap equals 10,000 exactly, and I find here this is the position. Okay, and this position corresponds to a volume of 1100. Does this make sense?
Yes, Professor.
Yeah. But if you don't like it, right, that's fine. You just plug in using that equation. Sorry. Just use this equation, right? That's quicker to do the calculation. So again, blue minus orange, right? That's the 10,000, right? So I want to use this red arrow to measure what is 10,000 on the graph, right? And then I move it, right? And this gap fitted best at this location. And then if you use the equation, right? If you use the equation calculation, blue is 80x, orange is 60x plus 12,000, and you solve x equals 1100, okay? So this would be the method for the first approach, right? Mathematical equation approach. And what's the expected sales in dollar? Just use the expected units of sales times units selling price 80, right? Okay, so how are we doing with time? So we have about 4 minutes. So I'm just about to talk about the net income. Okay, so I can talk about this on Tuesday, next Tuesday. Let's see. Okay, I still have 4 minutes, right? So let's work on this one. Let's work on this question, okay? Laimi, are you done with this question? Is that a legacy hand?
No, I'm still working on it.
Okay, yeah. So Santiago, you said the answer is C. Why? Okay, I have a bunch of hands up. So I'm going to pick those who haven't answered. Kaylee?
B.
B, okay. So I'm just going to pick those students. So all the other person with hands up, you have already answered the question. I'm just trying to give the opportunity to people who haven't answered at all. So I will give you guys 1 more minute. So for those of you who haven't speak up yet, this is your opportunity for participation. Patricia?
A.
A, okay. Dailin? Darlene? Santiago?
B.
Santiago, what's your answer?
C.
C, why?
So 280,000 is the total, so I just multiply that by 40%, and then subtracted the operating income.
Okay. Okay, so I'm going to show because we are at the time of the class, right? I'm going to show you. So in dollars, you use total fixed cost plus operating income divided by contribution margin ratio. The in dollar sales is 280,000, and the contribution margin ratio is 40%, 1 minus 60%. Operating income is 51,000. So when you solve this equation, you'll figure out total fixed cost is 61,000. Okay, that's it. So class is dismissed. Please stay if you have any question. Okay, thank you guys and have a wonderful weekend.